Mistry, the co-founder at Buoyant Capital, is joining us on the show to talk to us about that. Jigar, hi, good to be speaking with you. Well, a lot of market participants right now are very, very confused to the end that on one end, clearly it looks expensive, there is euphoria in parts, there is that liquidity gush, but on the other hand, you have a massive FOMO and you miss out on the rally if you don't deploy. What are you doing about it?
Right, Anisha. So as you mentioned, I think all of us are in a very similar boat. I think what's transpired is two things, right? Till October 2023, all of us were of this opinion that the fundamentals and the underlying valuations are broadly in sync. But after that, I think two events happened that completely changed the trajectory of the Indian markets. The Fed appeared to pivot sooner than expected. For almost a year, nothing happened, right? And obviously, the US markets reacted to it. But when you look at the Indian markets, given the sort of wealth that the retail has generated over the past 3 or 4 years, I think the valuations continue to remain a little more expensive than what we would have imagined. Add to that the sort of the actuality that you have had the most orderly wind down of any rate hike cycle since the 1980s that we have seen with the Federal Reserve, right? So 1980 obviously resulted in almost a 20% contraction of GDP, and all subsequent rate hike cycles, right? The late 90s, 2007, and obviously the 15 to 19 one, all of them resulted in some or the other crisis. This time around, they've raised the rates at the fastest pace since 1990, and nothing seems to have happened. I've just written an article yesterday in ET explaining why that seems to be the reason. But with that in the backdrop now, I think what's really happening is how the retail, which has generated some phenomenal amount of wealth, is now taking over the entire situation in India. And therefore, if you look at just from a flow standpoint, I think it's quite possible that we would remain at this elevated levels, and all of us will now have to acclimatize to surviving in this climate, so to speak.
And broadly, where do you see more value coming in? Obviously, the answer would be large caps, but even in large caps, which are those sectors where you're seeing value to come in?
So, right, I think a couple of sectors, BFSI clearly sort of, comes to mind, because if I look at the earnings trajectory, one, if you look at the overall BSE 500, which is slightly the broader market and covers almost 93% of the entire listed market cap in India, when you look at that space, I think the June quarter results showed that the earnings growth is slowing down. So at the overall market level, you are seeing growth slow down. Secondly, on the within the sectoral space, if you look at the dislocation, so where the earnings growth has come through versus where the index performance has come through. So clearly, you are seeing sectors like, say, real estate, utilities, and industrials, where the sectoral growth has been faster than the earnings growth. So index has moved up way ahead of earnings estimates. Whereas there are sectors like pharmaceuticals and BFSI, where the earnings has been reasonably resilient, but given ownership issues, the stock performance has not been as great. And I think that is where our incremental focus is at the current juncture, even FMCG and durables.
Okay, I'll come to FMCG and durables in a bit, but within BFSI, where is that you're finding the maximum amount of comfort? Because BFSI has become too broad, right, from private public banks to insurance, financial ancillaries, the AMCs of the world. What is looking poised for the best amount of risk reward?
So Anisha, look at it from this standpoint that if you look at, say, private banks over the last year, the earnings have grown at something like 28%. But the share prices have, if you look at the bank Nifty, for example, which I agree is a little bit distorted because two banks account for almost 40% of index weights. But that hasn't really moved all that much. And I think people, attribute it a lot to the fact that it's more difficult to get deposits, and all those fundamental reasons, but all those fundamental reasons are reflected in earnings. Despite that, the index not moving was pretty much, I think, a factor of the ownership issues, right? So wherever the global interest rates are elevated, FIs have been net sellers. If you leave out the past 2 months or so, And in that scenario, they can only sell what they own. If you look at the 10 largest overweight positions of FIs in India, 6 of them were banks. So I think they sold what they could sell, which were banks. And I think we are sort of, masking that to mean that there are fundamental issues. If the earnings trajectory more or less continue, then I think with FIs returning as interest rates start getting cut, I think private banks would tend to benefit the most, followed by PSBs, right? PSBs have re-rated. We have held a lot of them over the past 3 years or so. But incrementally, I would say that, the business model dictates that their fee income, their cost to expenses, the cost to income basically, do not allow their ROE tree to mimic that of a private sector bank, in which case some amount of gap is par for the course, and they now appear broadly well poised. The least favorable sector within that is the MFI space. So we used to own a couple of names in the MFI space, which we now no longer own.
Okay. You have a negative stance when it comes to the real estate sector. Is it just because of the run up, the valuations have become expensive, that is why you're negative? Because the demand or the government support doesn't seem to come off when it comes to the real estate sector?
So two things. I think if you look at it from a fundamental standpoint, real estate in India is still a positive carry market, right? Which means that a person taking the risk. Now let's compare two broad markets. If you take, say, US, for example, the loan is given on a house. It's not given to an individual, unlike in India, where if, say, I buy a house, the loan is given to me. In that standpoint, I'm taking more risk, which needs to be compensated. But in India, the rate of interest is higher than the residential or commercial yields, traditionally because real estate was an harbinger of, say, some amount of black money, which increasingly is receding. But the fact that, it's a positive carry market still continues. In that scenario, it's difficult for that sector to attract a lot of investments, given where equity markets and equity returns are, and therefore from an investment standpoint, that sector doesn't really command a lot of incremental investments. Then you boil it down to sort of, yes, India needs to grow. A lot of nuclear families are now getting developed from joint families. So there is clearly a demand that needs to be serviced. And in that scenario, the housing sales should report that level of growth, which sadly, I think over the past 2 or 3 months, across markets. So Hyderabad, I think, is the worst hit. Chennai, probably the second worst hit. Some areas and pockets in Mumbai are reasonably okay. Gurgaon is reasonably okay. But across the board, I think both residential bookings as well as the new housing starts are not really picking up as well. And whereas the index earnings have flown through over the last year and the sort of index growth has mimicked that. But incrementally, if housing starts are the first signs of where the sector is going, then incrementally it behooves us to be a little more cautious as we approach that.
Okay, so that's a take on real estate, but I'm intrigued to hear your views on pharma, because the rest of the world seems to be incrementally positive on that, and that doesn't seem to be a space which has perhaps peaked, at least in a lot of market expert opinion. What then is making you circumspect there?
No, Nisha, I didn't say. We have actually a much higher allocation to pharmaceuticals compared to where our benchmark indices have been. And our primary sort of reason for that was that we believe that whatever led to the correction between 2015 and 2019 on the generics pricing, and again, there is a large article we wrote in ET in March last year, where we argued that there were 4 reasons which led to the drawdown in the generic prices in the US. And all those reasons seem to be behind as we sort of approach the new time horizons. For the first time, you have in fact seen the FDA also give out 483 forms without a single observation to 2 companies, if memory serves. And in that scenario, I think everything else seems to be falling into place. So pharmaceuticals is one of those sectors which I think is reasonably well positioned. Just that it's run up a little bit too much, right? I think if you look at the BSE Pharma Index, then that's up 70% over the last 1 year, whereas the earnings are up only about, I think, 40, in the mid 40 numbers. So I think, therefore, you are trying to, price in a lot, and generics at the end of it is a cyclical business. So you need to take care that we don't get carried away a lot too much. But yes, that sector is reasonably well poised.
And when it comes to the PSU space, does it still look expensive to you, given the fact that we have already seen some fall from the highs, but do the valuations still look expensive to you?
So some businesses, I think the way in which we have sort of started classifying a lot of these businesses basis the ownership, should actually make us think within whether that's a cohort that is worth monitoring, right? Because eventually you are buying these businesses, and if you are sort of saying, okay, just because the government is the owner, let's start pricing everything up, that becomes a slightly questionable way in which approach has to be taken. Secondly, there are some businesses which truly make sense, right? So, for example, some utilities which are getting nominated orders, some banks which are truly doing very well, are all par for the course. But I think what's really transpiring within some of these spaces, people are trying to say, for example, some sectors in railways or some defense companies are now trying to price in possibly 2040s and the returns therein. And with a singular buyer, albeit a government, the multiple needs to account for the risk that an investor might face should something happen 5 years down the line, right? If you're just discounting, say, a couple of years earnings down the line, then you are okay with this. But now that if you do the DCF of many of these companies, you're probably accounting for 2035, 2040 and beyond. And therefore, say tomorrow, if the government were to change, then would the same sort of philosophy continue? Will the order still be given on nomination basis? And before that, whether these companies will continue to make earnings basis what they are bidding at this standpoint. In that scenario, I think despite the 25-30% correction from top in many of these businesses, I think that is not fully discounting the risk that at least we are seeing. So we are no longer into that space, which we were at least say a year ago or so.
A lot of unknowns as far as that sector is concerned. So staying away from that, at least for the time being. Thanks, Jigar, for making time and speaking with us. Always a pleasure hearing your insights. Time now to slip in.
If you like this video, then like, share and subscribe to ET Now.